Everybody, welcome back to the channel. Today we're going to be talking about another major set of layoffs, which this time is happening at UPS. UPS now looking to cut about 20,000 jobs, close some facilities, and also reduce the amount of Amazon shipments it handles. So this comes at a time where we're seeing so many companies cut back on their jobs, cut back on their employment responsibilities. So many jobs are being cut across a lot of different sectors. We have a look across tech, we can see literally hundreds of thousands of jobs being lost over the last couple of years, that's for sure. This is affecting major amounts of people. It's becoming a rather present issue across a number of different sectors. Now, bringing this on specifically to UPS, we can see the situation where they're looking to cut 20,000 additional jobs. So, they're looking to slash these 20,000 jobs and close more than 70 facilities as they drastically reduce the amount of Amazon shipments they handle. The package delivery company said on Tuesday it anticipates making job cuts this year as it anticipates closing 73 leased or owned buildings by the end of June. UPS said that it's still reviewing its network to identify more buildings which may be shuttered. So you can see the scale of this, right? And we can talk about numbers, we can talk about positions, but 20,000 people, I mean, to put that into perspective, that is huge. That's one of the major set of layoffs that we've seen, perhaps even this year. We've seen some big sets of layoffs, but this really is quite a large one. And again, it comes at a time where they're looking to close a lot of facilities, it comes at a lot of time where they're seemingly looking to reduce costs. And again, this is what we're seeing when it comes from the statement. The actions that we're taking to reconfigure our network and reduce our costs across the business could not be timed earlier. This is coming from the CEO in a statement on Tuesday. The macro environment may be uncertain, but our actions are going to make us emerge as an even stronger, more nimble UPS. This is a situation for today, okay? This is a reality of businesses in 2025. Especially delivery companies, especially in the US. All of the issues that we're seeing related to tariffs are inevitably going to make things a little bit more difficult. It's going to be more difficult to handle orders, it's going to be more difficult on a logistical scale, and of course if we're seeing tariffs, especially on goods from China, are people going to be paying more than 100% additional tax or tariff on the product? Likely not. Right? So in January, UPS announced that it had reached a deal with Amazon, its biggest customer, to lower its volume more than 50% by the second half of 2026. During its fourth quarter earnings, in a conference call in January, the CEO said that the company had partnered with Amazon for almost 30 years, and when its contract came up this year, UPS decided to reassess the relationship. Amazon is our largest customer, but it's not our most profitable customer. So that's what was said at the time. Its margin is very dilutive to the US domestic business. So that's kind of telling, right? Obviously, when you think about Amazon, you think scale, you think about the amount of orders which inevitably are going to go through with Amazon. At the same time, apparently it's not their most profitable business. Amazon is a business very tight on margins, as we already know. So it kind of makes sense that after a contract essentially seeming to end, or the current market conditions being the way they are, it might be time to reassess. So, UPS considered various options and determined that the volume reduction was the best alternative. The company currently employs around about 500,000 employees, currently 490,000, according to FactSet. So the company also reported its first quarter financial results on Tuesday. The Atlanta-based company earned $1.19 billion, or $1.40 per share, in the quarter ended on the 31st of March. Stripping out certain items, earnings were $1.49, per share, and that's better than the $1.44 per share that analysts were calling for. Revenue totaled $21.55 billion, beating Wall Street's estimate of $21.06. So clearly the company is doing better than expected, but as you might expect, with the way that the economy is looking at the minute, with the way that tariffs are affecting businesses as a whole, companies like UPS and others will have to adjust, will have to adapt. So we're seeing UPS essentially saying that it wasn't providing any updates to its previously announced full-year outlook given the current macroeconomic uncertainty. The company previously said that it expected revenue of approximately $89 billion in 2025. So this is going to be probably a story that we see more and more. You know, with the current economic situation, it's becoming very difficult for companies to manage and to deal with orders and to deal with profitability the way that they might have been able to do, you know, even before the tariffs, let alone a couple of years ago. A number of different factors are coming together now to make this a very challenging environment for businesses to deal with. But this is a reality of the situation, guys. Let me know what you think to this in the comments. Thank you so much for watching. If you enjoyed, let me know. Thank you. See you soon.